Welcome back to the deep dive. Today we are stripping away the press releases, the glossy PDFs, to look at a company that just posted what looks like a blowout quarter, only to get absolutely cold-shouldered by the market. We're looking at Texas Capital Bank shares.
It's good to be back. And you're right, the reaction to this one was, I was perplexed.
Perplexed is putting it mildly. I was looking at the tape on January 22nd. They dropped their Q4 and full year 2025 earnings.
Right.
And management is practically doing a victory lap. CEO Rob Holmes is on the call saying their massive multi-year transformation is officially complete.
Which is, a very bold claim in banking.
Bold is right. They beat earnings estimates. Revenue is up. Book value is up. And the stock market takes one look at this report card and just says, this stock actually drifted lower, closing down over percent. So my mission today is simple. I want you to explain to me why good news was treated like bad news.
It's the classic friction, really, between past performance and future anxiety. You have a bank that has objectively improved its engine.
Okay.
But investors are looking out the windshield and seeing some very specific potholes in the road ahead, mostly involving costs and some real estate jitters in Texas.
All right, before we get to the potholes, let's talk about the engine. Because on paper, this thing looks like a slam dunk.
It really does.
Yeah.
I mean, if you just scan the headlines, it's impressive. GAAP earnings per share came in at $2.12.
And what was it last year?
Last year, same quarter, it was at $1.43. So this is not a small incremental gain. It is a massive jump.
And compared to what Wall Street was expecting?
Wall Street was looking for 178.
Okay, stop right there. In the banking world, beating estimates by a few pennies is usually a win. They beat it by 34 cents.
30 cents, yeah. It was a 16% surprise. They didn't just step over the bar, they cleared it by a foot.
Wow.
And revenue was up 15% to over $327 million. And critically, they finally hit their target on return on assets, 1.2%.
Which has been their North Star for years now.
Ever since the new management took over, yes. They've been telling anyone who would listen, judge us when we hit 1.2% ROA. Well, they hit it. They also grew tangible book value by 13%.
Okay, so I'm the confused investor again. If a company tells me I'm going to do X and then 3 years later they do exactly X and they make more money than I expected, why am I selling the stock?
Right.
Is it just that people don't believe the transformation is real? Because frankly, every regional bank CEO I listen to says they are transforming. It's usually just a buzzword for, we fired some people and painted the lobby.
And that skepticism is healthy, but in this case, the transformation is actually structural. It's not just paint. They are fundamentally changing how they make money.
Walk me through that.
So the old model, the classic regional bank model, is spread lending. You take in deposits, you lend them out, and you live off the difference in interest rates. It's boring, it's reliable, but you are totally dependent on what the Fed does.
And the new model?
The new model is they're trying to build a middle market investment bank. They want fee income. They want to make money by providing services, not just by holding loans on their books.
So less risk.
Less balance sheet risk, absolutely. And the proof is in the numbers. They guided for investment banking fees to hit up to $175 million in 2026.
That's a serious number for a bank of this size.
It is. I mean, just look at their syndications business.
Syndications, that's a term we hear a lot. For everyone who doesn't work on a trading desk, what is that actually?
Think of it like being a matchmaker rather than a spouse.
Okay.
In a traditional loan, the bank lends the money and is married to that risk for, say, 10 years. In syndication, Texas Capital arranges the deal for a client, a $500 million loan, whatever, but they don't keep all that debt.
They sell it off.
They find other banks to buy pieces of it. So they structure the deal, take a fat fee for being the architect, and then offload the risk to someone else.
That's a much better business.
Yeah, exactly. And they're getting very good at it. They are now ranked number 2 nationwide for middle market loan syndications. Volume is up 40%. They aren't just a participant anymore. They are leading the deals.
That does sound different. It sounds more like Wall Street than Main Street.
It is. They even led their first sole-managed equity deal, which they claim is a first for any Texas-based firm. They're building a machine that generates cash without requiring them to bloat their balance sheet.
Speaking of balance sheets, there was another technical term in the report that sounded important but incredibly dry. Mortgage finance and enhanced credit structures. My eyes just glaze over saying it.
I know. It sounds like compliance manuals, but stick with me because this is actually the magic trick of their capital strategy.
Okay, explain the magic trick.
So Texas Capital has a big business in warehouse lending. They lend money to mortgage companies.
The people who actually write my home loan.
Exactly. So those companies have cash to operate until they can sell your mortgage to Fannie Mae or Freddie Mac.
Got it. So they're lending to the lender.
Correct.
Yeah.
Now, traditionally, regulators look at those loans and say, that's risky. You need to hold $1 of capital for every dollar you lend. That's 100% risk weighting.
So it ties up a lot of cash.
A ton of cash. It just sits in a vault, essentially doing nothing. It's like a security deposit,
Okay, huge security deposit.
a massive security deposit. But Texas Capital has shifted 59% of this portfolio into this new enhanced credit structure.
Mm-hmm.
And because of how they structure the legal protections, the regulators look at it and say, okay, this is actually very safe. You don't need 100% deposit. You only need like a 20 or 30% deposit.
Oh, wow. So they can do the exact same amount of business, lend the exact same money, but they get to unlock 70% of that security deposit and use it for other things.
That is the magic.
Correct.
It's a massive efficiency play. They're projecting mortgage finance balances to grow 15% in 2026. And because of this structure, that growth costs them almost nothing in new capital.
Okay, so we have a fee machine that prints money without holding risk and a mortgage machine that grows without needing a bigger security deposit. This all sounds fantastic.
Right.
So why did the stock drop? Where are the bodies buried?
The bodies are buried in the expense report and in a few apartment complexes in Austin.
Let's start with the expenses. I saw the guidance for Q1 2026. Non-interest expense is jumping to around $215 million.
Right. And that spooked people. The market hates expense creep. Investors see that number and think, wait, you just told us the transformation is over. Why is the cost of running the place still going up?
Yeah, it feels like they're saying we're done renovating the house, but we're going to keep paying the contractors.
Management's argument, and they were very insistent on this, is that they aren't paying contractors to fix the plumbing anymore.
Okay.
They are paying for front office talent. They are hiring bankers who bring in revenue.
The it takes money to make money defense.
Yes. But in this market, investors are skeptical. They worry about operating leverage. If you go hire a bunch of expensive investment bankers and then the economy slows down and deals stop happening,
You're stuck paying those high salaries without the income.
you're stuck. It's a fixed cost in a variable world.
That's a fair worry. Expensive growth is risky. But let's talk about the other worry, which feels a bit more tangible. The credit quality. You mentioned jitters. I saw an uptick in special mention loans.
Special mention is just banker code for this isn't a disaster yet, but we are watching it like a hawk.
The yellow traffic light.
Exactly. It's the yellow light before the red light.
And what's triggering it?
Multifamily housing. Specifically in Central Texas, think Austin, San Antonio.
I feel like we've been hearing about the Austin apartment glut for 2 years. Is it actually starting to hit the books?
It finally is. I mean, think about it. Everyone and their cousin built an apartment complex in Austin because tech was booming. Now, all those buildings are finished at the same time.
So too many units, not enough renters.
And the landlords are panicking. They're offering concessions. Move in now. Get 2 months free. Free parking.
Right.
When you give away 2 months of rent, your net operating income, your cash flow, it drops significantly. Even if the building is full, it's not making the money it was supposed to.
And if the building doesn't make money, the bank gets nervous.
The bank gets very nervous.
Yeah.
So Texas Capital is seeing this. They haven't had massive defaults yet, but they are downgrading these loans to special mention because the math is getting tight.
Which means they have to set aside more rainy day money.
Yep. They had to guide for a higher provision for credit losses in 2026. About 35 to 40 basis points compared to 31 last year. It's not a crisis, but it's a headwind. And the market hates headwinds in commercial real estate right now.
It's interesting, though. I noticed they are taking a very different approach here. A lot of other regional banks are saying, okay, the worst is over. Let's start lending on CRE again. Texas Capital is basically saying, no thanks.
It's a stark contrast. They are intentionally letting that portfolio shrink. They expect CRE balances to be down 10% next year.
So just letting the loans pay off and not replacing them?
Correct. They explicitly said on the call they're baffled by other banks growing real estate loans right now. They just don't think the risk is worth the reward.
Which goes back to the strategy shift. If you have that investment banking engine, the matchmaker business, you don't need to take risky bets on apartments just to show growth.
That's the luxury of the new model. They can afford to be picky. They call it discipline over growth. But the market, it looks at shrinking loan balances and gets nervous, even if it's the smart move.
So let's talk about valuation, because you've got a bank growing fees, fixing its capital structure, but scared of apartments. What does that leave the stock?
It leaves it remarkably cheap, at least according to their CFO, Matt Scurlock. He had a moment on the call that I thought was pretty striking.
I know exactly the quote you mean. It stopped me in my tracks.
He pointed out the stock is trading around 1.3 times tangible book value. And he did the math for everyone. He basically said, given their earnings trajectory, if they buy back their own stock today, they're effectively purchasing it at what book value will be in 2.5 years.
Translate that from CFO speak to normal human.
He's saying our stock is on sale. We know how much money we are going to make. If we buy our own shares now, we are getting a guaranteed return. It's a signal of extreme confidence.
Is it confidence or is it arrogance?
Well, it's backed by that capital position. We talked about the security deposit earlier. Their CET1 ratio, the main measure of safety, is 12.1%.
Which is high.
Massively high. Their tangible common equity ratio is the highest among the largest U.S. banks. They have the biggest savings account in the neighborhood.
So they have the cash to back it up.
They do. So when they say they're going to buy back stock, they can actually do it without putting the bank at risk. They bought back almost 5% of the company last year.
So here's the setup. You have the safest balance sheet, you're buying back your own stock aggressively, and you have a new fee-based business model that is actually working. But the price is stuck because everyone is afraid of some empty apartments in Austin.
That is the standoff. The bank has built a Ferrari. The engine is tuned, but they have to drive it through a construction zone. And the market wants to see them get through without scratching the paint before they'll award it a higher multiple.
It feels like a classic show me situation.
Exactly. 2026 is the year they have to prove that the expense hike, those expensive bankers, actually pays for itself.
All right. We've looked at the good, the bad, and the ugly. Now, let's pivot. Let's stop being reasonable analysts for a minute.
Okay.
If you were sitting at a hedge fund desk looking at this disconnect, what do you do?
Is it time for the disclaimer?
Oh, absolutely. This is not financial advice. We are two voices on a podcast, not your financial advisors. This is for entertainment. Do your own homework. Don't trade your life savings based on what we say.
Okay, disclaimer noted. If I'm a hedge fund manager, I'm looking at this and I am seeing a mispricing, a big one.
I'm calling this trade the Texas two-step capital arbitrage.
I like the name. What are the mechanics?
The market is treating TCBI like a standard regional bank. It sees bank in Texas and thinks oil and real estate. It thinks the stock moves up and down with interest rates.
Which is the old model.
Exactly. The market is ignoring the fact that they are turning into a middle market Goldman Sachs. You are buying an investment bank disguised as a regional lender. So the trade is simple. Long TCBI, aggressively.
What's the catalyst? What makes the stock pop?
The catalyst is that boring enhanced credit structure we talked about. I call it the warehouse whipsaw.
Explain.
Everyone thinks rates are staying high forever, but what if they drop? Even a little bit. In 2026.
Mortgage volume goes up.
It explodes. TCBI is already guiding for 15% growth in that segment. If rates drop, that number doubles. And here is the kicker. Because of that magic trick capital structure, they can handle that explosion in volume without raising a single dime of new capital.
So their return on equity goes through the roof.
It's rocket fuel. Most banks, if they grow 30%, they have to go to investors and say, please give us more cash for the security deposit. TCBI doesn't. They just print the money.
That is a compelling arbitrage. You get the upside of volume without the downside of dilution.
Plus, you have the CFO basically handing you the math. He's telling you, I'm buying this stock because it's trading at par with future value. It's a compounding machine.
So the bet is?
You are betting that the special mention multifamily fear is a temporary blip of fake out that gave us a delicious entry point.
It's high risk, though. You are betting the Austin apartment market doesn't completely collapse.
True. If those special mention loans turn into defaults and they have to foreclose on half of Austin, this trade hurts. You catch a falling knife.
But if management is right.
If they're right, if they just execute the playbook they spent 3 years building, you're looking at a double-digit compounder that is currently on sale because people are scared of a few for rent signs.
It's the investment bank in disguise thesis. If they can keep those fees coming in, the market will eventually have to re-rate them.
The 2026 expense guide says they are playing offense, they're spending money to score points. Now, They just have to put the ball in the end zone.
We'll be watching to see if they do.
That's it for this deep dive into Texas Capital. Thanks for listening. Keep your eyes on the numbers, and we'll catch you at the next earnings print.